everyone on our Tax Savings Tuesday. We're going to discuss about the current trend for the annuities. I'm Chris, Wycoco business developer, IRS acceptance agent, and wealth strategist of my company. We've been in the industry for more than 8 years on my own company, but we have more than 30 plus years of combined experience doing wealth planning and the accounting. So today we're going to give you some insights on the other investment that you can consider that has tax benefits, and that is about the annuity. For those of you that are listening, let me know where you're from, what state or cities. And this presentation, we have a replay. Where can you find the replay? It's going to be on our YouTube channel there. All right. So today, okay, I think I'm sharing my screen already. Now, okay, mic test. Are we back? Can you guys hear me? All right. Let me wait for the comment if they can hear. Hello, mic test. All right, there you go. Can you guys hear my audio? Can you hear my audio? Test, mic test. All right. Okay, there are. We're going to continue with our presentation. So again, so this presentation is only less than 30 minutes. Be a part of our gift card raffle. All you have to do is follow us on our YouTube channel. It's Chris Wycoco, and we are giving away gift cards. This material has been prepared for informational purposes only. It is not intended to be provided or should be relied for any technical answers. This is not a legal or accounting advice. Again, we're just giving you educational information. On any institution on this presentation, it is not associated to us. All right. So the target client that may benefit on this presentation are small business owners, self-employed, and work from home. People that are receiving 1099s, have S corporations, LLCs, partnerships with or without employees, with or without e-commerce, high non-accountants, and high income professionals. The current trends in annuities. Remember, there are three types of annuities. It could be fixed, where it's giving you the steady return on the rate on your investment. Variable would be, it doesn't have a cap. It could be the highest amount you can get, or the you might even lose your money from this type of annuity. I mean the variable, it doesn't have the flooring. All right, the index annuities are the ones that they have the cap, either 3% to 9 or 3% to 12%. So it really depends on which product you are more comfortable, what level of risk you would like to take. So, but the current trend for fixed annuities, it increased the interest in a multi-year guaranteed annuities, or what you call the MYGAs. With rising interest rates of MYGAs offer fixed returns over several years, attracting those seeking predictable income with higher yields than traditional savings accounts. Whereas the variable annuities, growth of investment is focused variable annuities. Many now offer a wide array of investment that includes the environmental, social, and governance, or the ESG funds, to appeal to a more socially conscious investor base. And lastly, the index annuities, popularity of hybrid designs that combine the traditional fixed index with features like downside protection and a portion of market link gains, offering a balanced growth potential and safety. The three key roles of the annuities in the retirement is the guaranteed income, principal protection, and tax deferred growth. When the guaranteed income stream, annuities provide a reliable source of income which on your retirement can last for life depending on the type of the annuity. This can help cover essential expenses in retirement, offering peace of mind against outliving your savings. Uh, but remember, you are relying on Social Security as your vehicle. It might be too small for you because the government can always assets that you have when you retire, and they will base, the more assets you have, the less retirement they will give. Okay, so that's why you take control of your money, take control of the cash flow that you have. While you're earning more, diversify, 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 and your income should always be going back to you most of the time. Okay. Next, principal protection. Certain types of annuities, such as fixed or index, offer protection against market downturns, which means even you put, let's say, $1 million there, and today it's still gonna be 1 million. If worse things out, there's a guaranteed 1 million that the principal is still there. That's why this is a little better option, or a better option rather than 401k, because I'm pretty sure you heard some of your friends, they lose money on 401k. They're losing what they said, the principal that they invested. And number three, the tax deferred growth. Annuities allow investments to grow on tax deferred until withdrawals begin. This can enhance growth potential, especially for those looking to delay taxes until retirement when they might be in a lower tax bracket. That's a good thing because the older you get, the less income you get. So therefore, the tax bracket goes down as well. So that's why you have this kind of strategy to defer the taxes, growing your money, putting your money in tax deferred, and then withdrawing your money when you don't have so much source of income. So therefore, your tax rate will also be lower. But what are the risks, benefits, and fees associated with annuities? Number one, liquidity risk, because annuities often come. Remember that this type of investment, you should be looking around more 7 years and more. It's not something that, do not think of this as a bank. Okay, this is more that you don't need this money for the next 7 years or so, because every type of long-term, mid-term investment have associated surrender charges, which means they will might charge you something ranging from a few years to a decade, during which your withdrawals can trigger surrender charges, and also what you call the penalty, 10% taxes, 10% of the withdrawal amount. Because remember, if you're not 59 and a half years old, anything that you withdraw from this type of portfolio is taxable. Market risk, specifically for the variable annuities, that's the reason why we focus on index. For variable annuities, returns depend on the performance of chosen investments, and there's a potential for the loss of principal in down markets. And lastly, watch out for fixed annuities called inflation risk. Fixed annuities provide a guaranteed return, but they may not keep pace with the inflation, eroding purchasing power over time. The fees, these are the top four fees that you're going to check with your financial planner. The first is mortality and expense risk charges. This is a typically percentage of the annuity's account value charged annually, covering insurance guarantees. We also have administrative fees, a fee for managing the annuity between 0.10 to 0.30% per year. Then rider, if you want to have a lifetime income rider, the fees often come with additional between example 0.5% to 1%. Then lastly, investment management fees. For variable annuities, there are fees for the underlying mutual funds or sub accounts between 0.5 to 2%. So it's better for you to know this before signing up and whether your investment is worth it. And the benefits, of course, we cover a lot of this to sum it up. Guaranteed income for life, because if you put 1 million today, it can potentially double on the next 15 years. So you have a 2 million that it can spread out from 65 years old until 100 years, divided on those. That's what you call a lifetime income. We mentioned tax deferred growth. Any money that accumulates that grows right now is not subject to taxes until you withdraw them. Principal protection, because I'm going back to the tax deferred growth. The bank doesn't have this. You put your money to the checking account. Guess what? Every year they charge percentage on the interest that your money is making. And now, how much is your money making in the bank? 0.00 something to nothing. And number three, principal protection. That's the reason people put their money from 401k rolling over to here or IRA to here. It's because no matter what happened, you are guaranteed that you still have the amount of money you put, whether it's 1 million, whether it's 100,000. It fixed and index have this kind of feature, principal protection. And then customization. Annuities can be tailored with riders like death benefits, guaranteed minimum income, and long-term care options. A lot of people, this is thinking that, oh, this is only when lifetime income, but it also when can be used for long-term care. Let's say at the age of 75 years old, like the mother, she started to get facility like home health, maybe less than 12, 14 months, she can use some of the monies for to cover those expenses. Okay, so why Wyco tax? We stand by our name. We're worry-free, year-round competitive, on-time accounting and wealth planning service solution here in the US. We're giving you 5 benefits of outsourcing to us: the peace of mind, save headache, save time, save money. Then faster access to grants and loans. When you have more assets like annuities, the higher chance that you get the loan. All right, so the income tax, the first thing that we do is initially we check your type of taxation, whether you're being taxed now, taxed later, or taxed never. How much is the tax rate if you're being taxed now? Then after that, we will give you a cash flow, monthly income report, asset and liability report, debt management, emergency fund. All of these are part of a free 30-minute consultation. Then we will take you to the wealth planning journey. They said people don't plan to fail, they just fail to plan, and finances is something that everybody need to be planning. So the first 1, 2, 3, 4 on your left until the supplemental college funding, this is when you don't have a business yet. Okay, so the first thing is knowing your income expenses monthly. Then from there we would identify how much budget you can invest, because we want you to make sure that you're comfortable with what your money you're investing, that you don't uh, run out or short with the basic fixed expenses like more payment of the mortgage, lease, utilities, internet. And then after that, when let's say for example the nurse practitioner in New Jersey, single mom, 350,000 earner, she passed away. So therefore, the beneficiary, like the kids, will not be left empty-handed with no financial losses. So that's what legacy planning is. There's something financial that will pass it on to your beneficiaries. Then income replacement. If the in case that the owner did not die, but she has a 1 million policy, but she got diagnosed with cancer or any stroke, critical illness, up to 90%, like a 1 million policy has a 900,000 access, non-taxable benefit that you can use to go back to your normal state or your health status, all right, without going to GoFundMe. And then people said, "Oh, I have health insurance." Well, guess what? Do you think the company that you work for, they're gonna keep you forever? So what's gonna happen if your therapy took for 2 or 3 more years or so? Where are you gonna get the money? So that's the reason why you need to have like a supplemental funding for the treatment. But if you're healthy and then there's no incident of death and dying, then the kids can use the money for education. And this education, the money that the cash value that grows can be used. So basically, you're becoming your own bank with this well planning journey that we have. And then at the same time, if ever they become scholar, you can use that the cash value to anything without being taxed, from travel, putting another business, buying a new house, buying your dream home in the Philippines or other countries. But then, if also in case of it also has the potential to cover other debts. Okay, so instead of or your family continuously paying the debt, the benefit or the debt benefit of this can be used for payments of mortgage. So there's just so many. The well planning is something that you need to have from us. And then business. This is when you have a business. We can also develop a plan where the product that you're getting from us will be meant to increase the asset, to cover you from a buyout agreement, exit strategy. All of those components play a major role in increasing the asset, increasing the cash flow, minimizing the tax and liability. And most of all, talking about liability, the last part of this is the estate tax coverage. So estate tax means when you pass your plan, when you pass this to your family, they're not going to be paying taxes. Okay, so that is a lot of people that make millions. They left. I think 30% was collected by the IRS. So this one is also part of our service, is making sure that there's no probate tax or inheritance tax when you pass your legacy. All right, so that would be all. If you would like to connect, find me our YouTube channel, Chris Wycoco, and our LinkedIn. We have everything: Instagram, Facebook. If you find this interesting, and then if you need a copy, feel free to download this well, text us. And also, follow us on your YouTube channel so you can do the replay. Okay? Again, guys, thank you for watching. Every second and fourth Tuesday, we do this Tax Savings Tuesday. I'm Chris Waikogo, because our goal in our company is to increase your cash flow, but not your taxes, and break those taxes so each one of you can take a break. Thank you so much.